It is a humbling thing to be counter-programmed against Kobe Bryant, but here we are. Thank you for having such a deep interest in the outlook for M&A and for joining us here. The nice thing about this is we do have a nice intimate audience, and hopefully we'll make this very interactive. We have a lively group of people. I'm going to have them introduce themselves in a minute. When we go to Q&A, we'll do that with maybe 15 or 20 minutes left to go. Please raise your hand, and a mic will come to you. And they will, and one thing I do ask is that maybe direct the question to a specific person or run the risk of me directing it for you. The lights are pretty bright here, made more so by the shine off of Joe Reese's head in the back. So anyway, so we're off to the races. I want to start at my far right, stage right, audience left, as they say. John Donkold, please introduce yourself.
Yeah, my name is John Donhockle. I'm a managing partner of Leonard Green & Partners. We are a traditional buyout firm located in Los Angeles. We have approximately $20 billion under management. And I'm going to leave the remarks about the market or opening remarks to the other panelists here who have a broader perspective. But my objective for this is that we will have all the thrills and chills that the buyout panel had, no less.
And one thing just on the subject of Kobe, as we were talking about this, that it's one thing to be Kobe, it's another thing, you own half of Shaq.
Yeah, right? We have a company called Authentic Brands. It's a licensing business, and we entered into a really a partnership with Shaquille O'Neal. He was at our investor conference last week. Amazing guy. He's huge and a huge personality. But what we do is we invested in this business 7 or 8 years ago. We have basically sports. We license sports names, companies like Spider, Prince, and then we also have personalities. So we have the rights to the intellectual property associated with Muhammad Ali, Elvis, Marilyn Monroe, and a portion of the intellectual property associated with Shaquille O'Neal. So it's that is our most fun company for sure.
And so then we move to the Muhammad Ali of the big accounting firm, Steve Kruskus.
Yeah, I'm not sure I can claim that much fun, but Steve Kruskus, pleasure to be here with you. I have the privilege of running the transaction advisory services practice at EY, which is about 13,000 people globally. I spend as much time, probably a little more time, outside the U.S. than I do inside the U.S., so I hope to bring some interesting global perspectives to the discussion today. What you'll hear from me in high-level terms on the market is I think we are headed for a strong year in 2016. I don't expect it to be a record year. Every year is not going to be a record year. But I think there's a lot of strength and a lot of momentum, which we'll get into in the discussion as we move along.
Great. Jennifer Nason.
So Jennifer Nason, I'm responsible for JP Morgan's global tech, media, and telecom investment banking practice. So I'm also very happy to be here. So thank you for having me. And I guess what I would say is the number of factors at play today in a decision that a board might make around an M&A deal. It's a very long list today, from concerns about technology and what assets that you need and where in the world you need them. The fact that money is really cheap, the fact that IPOs aren't getting done. We have Chinese buyers coming into the US market. We have activists everywhere. We have a lot of cash on balance sheets. So there's just a lot of factors at play today in making the decision about whether to buy or sell anything. So we're as busy as we've ever been. We're just not getting as much over the finish line as we would like right now.
Robin?
Yeah, thanks. Robin Rankin, I co-head the global M&A business at Credit Suisse. I echo many of the comments and agree with Steve. This will be a strong year for M&A, may not top last year's, which was a record year. There's a number of things that we're seeing as key themes in 2016, including the cross-border M&A activity is running at about 45% of total volume, which is up substantially from historical averages of around 30%. As Jennifer mentions, activism does remain a very important part of the business. In the US, the campaigns are about flat, but if you look globally, Non-U.S. activism campaigns are up about 30%. And the last piece I might mention is hostile activity, whether it's in the States or around the world, in terms of number of transactions is up about 70%, and we see that continuing. So the stigma of not doing a hostile because it somehow seems inappropriate has long been lost.
A fitting end given the history of this conference. Anyway, go ahead.
Yeah, so my name is Paul Stefanik, and I'm the head of America's corporate and investment banking for Deutsche Bank, and I'm also responsible for our global M&A business. And I agree with a lot of what's been said already. What I would point out that in terms of the M&A market, really what we're still seeing is a search for growth. So if we look at the last recovery, about 85% of the gain in the S&P came from earnings expansion. This time around, that number is only about 20%, and more than half of the gain in the S&P has really been from PE multiple expansion. So again, that need for growth and the lack of organic growth is in, I think, many of our views, creating the need for more M&A. We talked about cross-border, and some stats were given out in terms of 45% of the market, but a quarter of that is actually coming from China outbound into Europe and the U.S. in particular. So a very important part of the market. In terms of activists, I don't care what anybody says. I think it's a real asset class. It's $130 billion of investable assets sitting in activist hedge funds. The interesting thing, last year there were about 550 campaigns from about 400 activist investors, and that was a record. The interesting thing, though, and they obviously emboldened, they've outperformed the broader market over the last few years, but not the last 12 months. Remember, these tend to be concentrated investments, not necessarily broad-based, and they've underperformed the broader market by more than 20% over the course of the last 12 months. We should talk about financial sponsors. Financial sponsors are about 25% of the broader market, but LBOs are actually only about 5% of the market. Sponsors have monetized at a rate of 3 to 1. They've been selling their assets as opposed to investing in new LBOs. There's about $700 billion of dry powder there that needs to be spent. And then lastly, we talked about hostels. Hostels increased 40% last year, but they're really hard to get done. And that includes hostels in the pure sense as well as deal jumping. And so again, I don't think that will abate anytime soon. But anyway, I thought I'd throw some chum out in the market for purpose of discussion.
I want to stay with what you were talking about with activism, because I think it's on a lot of people's minds here. And Robin, those were really interesting stats that you contributed. So is this how M&A works going forward? Or is this a sustainable level of activism, or are we seeing sort of a peak? How much is cyclical and how much is secular when it comes to the activist activity right now?
Well, I think that what Paul mentioned is really important in terms of the reason why there's been so much activity on the activism front is simply that they have generated alpha relative to the overall market, and therefore they continue to gather more and more assets. That has changed a bit. And the concept of sort of a low-hanging fruit in terms of targets is less apparent, and you see that in the trend of going outside the states. I think there's a big question mark as to whether we've sort of hit a steady state leveling off. I don't think we're going to necessarily see a big deterioration in activism, but I don't think we're necessarily going to see the kinds of growth we've seen historically. When we look at activism, about 40% of companies that encounter activism then result in doing some form of M&A transaction. Again, I think that that's going to flatten or perhaps reduce a bit, simply because we're running out of people that have conglomerate discounts or that type of thing. I don't know if others
I'll jump in, Jason. I think activism is a permanent feature of the boardroom, of the U.S. marketplace now, and I agree with Jennifer. I think you won't necessarily see an increase in the level of activity, but it's steady state. I think where you're going to see an increase is outside the U.S., and we're already seeing it across Europe. And look, it'll take different forms. It won't be structurally and legally done the same way, but what it's basically is governance, better stakeholder balancing. seeing it through Europe. I think you're effectively going to see it in China with some of the SOEs rebalancing their portfolios and tightening up. And I think you're going to see a wave across Japan as well, because there is a lot of efficiency to be gained and optimization to be gained in enterprises there.
Although we had the, sorry, just
Yeah,
we had the Sony, we had the big Sony example a few years ago, which was sort of very controversial in Japan because, you know, here's Sony, a company that was the Apple of the 1970s and 80s, massive destruction of market value. They've rebuilt, but that was a very hard campaign. And the only other comment I was going to make is I'm not even sure we're going to call it activism for very much longer. It's just shareholders being more vocal, and the long-only investors are every bit as vocal today as the traditional activists.
So John, I want to bring you into this because it seems like that activists may be going after some targets that traditionally private equity might have gone after. Is that true, and does it change your business at all and sort of the opportunity set?
You know, I'd say it's sort of around the margins maybe. It's not a, I personally don't have, I don't hold the activity in terribly high regard. Again, it's a tool. Sometimes it's a good tool. Sometimes it's not a particularly good tool. I think a lot of the success over the last few years has basically been a function of a rising market and an active M&A market. So sort of what's happening is if you're in, whether you should be, whether you shouldn't be, because folks are so voraciously interested in other businesses, they make things happen. But, you know, activism by its nature tends to be a transformative, good, disruptive, bad, short-term, generally speaking, bad. What we do is long-term investing. So if you sort of, what they will periodically do is they will sort of get things stirred up and provide opportunities for us to effectively take these businesses and, you know, hopefully put them on a more stable path for, with a longer-term horizon.
Right. And a lot of this, Paul, it seems like so much of this is personality, you know, coming from the media side. You know, these personalities have come to sort of dominate in a way that we haven't seen since the 1980s. You know, activists are sort of the new M&A rock stars, at least for the moment. It was the private equity guys, but you know.
Well, as I said, they were particularly rock stars when they outperformed the market.
Right.
And I would just add one thing to that. You know, one of the law firms, you know, uses the term reluctivist, and that really applies to the traditional, as Jennifer said, the traditional institutional investors who are now being more vocal. So think, you know, T. Rowe Price, and think CalPERS and CalSTRS, who are now weighing in and offering their, you know, their point of view of, you know, many times in concert with the activists in certain situations.
Right.
You know, I was just going to say, a lot of it, I think we all have to remember, a lot of this is never public. So the Carl Icahn moves, or the Nelson Peltz, and all the big rock star names, we read about that when they act. But a lot of the work that we do is done behind the scenes with investors, having discussions with management teams and boards, and is never you know, how that transpires is never necessarily public.
That's a good point. I mean, there's a lot of activism in, you know, $5 billion or less, right?
Yep.
Size companies, which you never hear about. Never see.
And so, staying with that, I mean, how does that change the prevalence of that? How does it change the mood or the posture of a boardroom or a management team, given these numbers that we've talked about and how much more active it seems?
I think it's constantly in the background at a minimum. So if you're a board sitting on a cash balance, for example, and interested in making investments around the world to grow your business, every board meeting to discuss an opportunity will say, okay, investor reaction. What are they going to think? And what is the likelihood that somebody decides to pick up a pitchfork in the context of me announcing this deal and give us trouble? Or if I've got a business that's not performing particularly well, you know, what are the chances that somebody comes in and tells me to sell that business or spin off this division? So it's a constant element. And one might argue these are questions boards should always be asking as they seek to maximize value for their shareholders. But it's sort of front and center in the discussion now about what if an activist shareholder decides to take a look at this, how might they respond? And that's paralysing boards to some extent in decision making.
It can paralyze in some situations, I suppose, but I think it's enabling in others, because I've seen a lot of companies adopt activist playbooks where they're proactively trying to understand how an activist or how any outsider might look at the business to maximize value, which in many cases has been a healthy process.
Yeah, if I can just add to that,
Yeah.
we often tell our clients, our boards, that they need to be their own activist, right? Assume that if somebody were to show, what would they try to claim, and then obviously make sure that you're prepared, so that if in fact that does happen, you're prepared. You can say, we've thought about that. We didn't think it was a very good idea. Here are the reasons, as opposed to just saying no to everything. And I think that happens, throughout most of the boardrooms in America, if not the world.
And Steve, you guys have done some very recent work on sort of mood inside the boardroom and mood among management teams. I mean, what do you distill from that, in this context, but of activism, but also sort of beyond as it relates to M&A?
Sure. So we do a very in-depth survey every 6 months on attitude toward the economy globally, the M&A market. We just released the most recent one 2 weeks ago. It's called our Capital Confidence Barometer. And the accuracy that it's shown over the last 4 or 5 years of predicting the M&A market in the following 12 months is absolutely astounding. The correlation is in the high 90s. It is, so what it's telling us is that M&A will continue to be very strong. Why? For a few key reasons. One is growth, which Paul mentioned earlier. It's the only way to achieve growth in many corners of the world. Secondly, it's about globalization. 75% of the companies telling us they intend to go global. And by the way, 50% telling us they intend to do a deal in the next 12 months, do an acquisition. And that is well above the long-term average, which is around 40%. So, very healthy market. So it's about growth, it is about global, and it's also about digital disruption. The digital era, technological advances are disrupting the way a lot of companies do business, and that is creating more deals, it's creating more alliances, which in fact, I think we could get into an era of talking about M&A, moving that discussion to M&A, mergers, acquisitions, and alliances, because alliances are becoming bigger and bigger.
What does that mean? What do you mean by an alliance? Just sort of some sort of cooperative agreement that doesn't involve actually getting married?
Absolutely. A cooperative agreement to take advantage of the strengths of two different parties in different corners of the world. For example, my firm announced an alliance with LinkedIn recently, which will enable us and enable them to do things that we couldn't do on our own. One of the comments on stage yesterday at one of the panels was around an alliance we have with Microsoft. So, in professional services, in technology, in automotive, really up and down, any industry you can think of, alliances will be a tool to take advantage of resources of others, preserve your options without a significant investment of capital in some cases, because let's face it, there is a lot of uncertainty around how certain sectors will evolve, so preserving optionality is good.
Yeah. Robin, I want to ask you about sort of board level and management confidence. I mean, that's something that I think you've spent some time looking into and thinking about. How confident are CEOs generally, and are there pockets of stronger or weaker confidence as you look across your clients and landscape?
I think that in general, I think that the boardroom and CEO level of confidence is very high. I think that 2015, you saw all things working very well. People have run out of sort of the cost cuts and so forth, and people are looking outward, and they feel that their own businesses are in pretty good shape. Both the financing markets and some of the buyout activity and so forth slowed pretty substantially in the fourth quarter and the first quarter. And a lot of people asked us, okay, what does that mean for the overall M&A market? And while, as Jennifer points out, it was a bit more difficult to get things over the finish line or things elongated in their process, the level of strategic activity or the confidence with which people want to pursue significant M&A transactions, I don't think has waned. And so I think that we're going to see the back half of the year be very strong for strategic transactions for all the reasons that the various panelists have mentioned. not to switch courses here a bit, but the one other place that, and John Donhocker will probably speak to it as well, the couple places that we haven't seen the M&A market or activity be as frothy, for lack of a better term, is in the buyout world. Maybe in part because valuations are too high, maybe in part because financing isn't there, and I'll let Mr. Donhocker speak to that. But there's a piece where I think that we will see activity increase over the second half of the year, and that's been a little bit more quiet, as well as emerging markets.
All right, Don Huck will jump in. It's going to be a good back half of the year for you guys? For your business in general?
You know, I'd say it's picking up a little bit in part because there was sort of the financing markets were shut down sort of the first quarter of this year for the most part. You know, I would say it's sort of, to me, it feels like it's kind of at the right level. And one of the reasons for that, sort of paradoxically, are some of the restrictions that the Fed has put on financing protocols. So where our business tends to get very overheated is if you can borrow more, you pay more. If you can borrow even more, you pay even more. With a sort of 6 times cap, with a little bit of fooling around, but sort of 6 times ceiling on financing, which financing tends to be low cost prior to the beginning of this quarter, things are kind of, they're sort of okay. I think, you know, based on the statistics that we see, multiples on average are up maybe a point one time. The one area of the business that does concern me, and the area that we're sort of staying away from, is what I'll call the slower growth businesses, because you know, again, what the Fed has sort of done is they put, if you buy a 12 times company, you can borrow 6 times. If you buy a 9 times company or an 8 times company, you can borrow 6 times. Same kind of leverage, even though the growth and risk prospects of them are different. So where we're staying away and where we're, you know, there's sort of no activity is kind of those sort of steady eddies, you know, slow to no growth businesses. Those used to be sort of 6 to 7 times deals. They're sort of the 8 to 9 times deal, and that's what I'd call kind of the dead zone in the buyout business right now.
But I mean, Paul, that used to be where private equity, sort of classic private equity, thrived, right? I mean, it didn't rely as much on growth. So that would seem to indicate a pretty fundamental, if maybe temporary, but fundamental shift in the buyer landscape.
Well, I think the issue was touched on, is that if you look at the leverage levels over the last couple of years, it's been sub 6, you know, high 5s. But the multiples that people are paying have been, you know, a little bit north of 10 times, which means there's more than 40% equity in these deals. It's hard to get the returns if we're in a relatively low growth environment. How do you get traditional private equity returns in that environment? So you need to be right. I mean, cheap financing has helped that somewhat, but it can only help to a certain extent. But yes, that's the bread and butter. I mean, I think there's 675 billion of dry powder sitting within private equity firms right now. So if you lever that, you've got a few $1 trillion of transactions that need to happen. And as I said, they've been monetizing far, you know, at a rate of 3 to 1 relative to what they've been buying, but there haven't been a lot of great opportunities to buy primarily because of pricing. And then one other factor, again, we haven't seen a lot of traditional going private transactions. Right. And the reason for that also relates to corporate governance, which has evolved to the point where it's very hard to do the, hey, show up and with a private equity firm and take the company private. The board is not going to allow that to happen, as you all know. If you're going to do that, you're going to have to go through the entire spectrum of all the strategic alternatives for the company, and maybe that's the right one at the end of the day. But you've got, you know, the governance, which is appropriate. You've got to go through the right process.
So Jennifer, edge to the strategics then in this market, and specifically in the area you look at in TMT?
Yeah, well, certainly in the TMT space, although traditionally it has been a pretty fertile ground for sponsors. I think strategics generally, and certainly around the world, you know, there's a bit of panic, I would say, as people wonder what assets they need in what parts of the world, as technology cycles just seem to be getting faster and faster. So I totally agree with the alliance notion, and that often comes with minority investments. I mean, we saw Verizon just put make a minority investment in Awesomeness TV, and then we saw NBC come in over the top and buy all of DreamWorks. So the sort of point counterpoint assembling of assets, particularly in the TMT sector. The pace is frenetic, but it doesn't always mean you have to go in and make one big bet on one company and hope for the best. I think people are a lot smarter this time around than they were, in the days when Time Warner, AOL happened. And memories are long on that deal, by the way.
It's interesting. There has been, if you look over the last 5 years, I think double, nearly triple the number of deals of non-technology companies investing in technology companies for some of these sector disruption trends that we talked about.
So we talked a little bit about the financing market, maybe coming back a little bit. Another area that has been less than robust, shall we say, is the IPO market. What do we expect to happen in the back half of the year here, Robin? I mean, is there a thaw? What's happening with IPOs?
Well, yeah, if you look back over the last 12 months, and a lot of times we obviously, when companies are thinking about monetizing, we look to both the public markets as well as to selling. And in general, over long periods of time, it usually ends up roughly half the time they go one way or the other. Over the last 12 months, it's clearly been tilted to the sell side. There really hasn't been an IPO market. The IPO market appears to be opening. As to how quickly or how robustly that will occur. Only really pristine companies are able to start out of the gates. But I do think the IPO market certainly will improve over the course of the next several months.
Well, it's a pretty low bar, right? I mean,
Exactly. That's not a wild prediction.
Well, if I could just add to that, though, I mean, obviously the way it always starts and the way it's starting now is the companies that are actually making money with positive cash flow are actually going to be the first ones out, and that's kind of what we're seeing.
That's crazy talk.
In the backlog. Right? It's crazy talk, but it always happens that way.
Yeah.
But remember, the IPO market is always open. It's just a question of whether you, the seller of your company in an IPO, will accept the market clearing price. So you can get a deal done at any time, in any market, if you will accept that valuation. So right now, valuation expectations are out of whack with what the market will bear. So I think we've done one IPO in tech all year. It was a couple of weeks ago. It priced below the range and it traded down. So that does not bode well right now for certainly tech IPOs, and we have something like 60 or 70 in our backlog. So I still think it's going to be a long road out for the rest of the year on the IPO front, unless sellers just decide, I'm going to recalibrate valuation expectations. And remember, when you're in tech and you're growing and you need money, you've got to get it from somewhere. So if you're not going public and you don't produce cash flow, so you can't borrow money, you're potentially doing down rounds of private equity, and that's a really hard pill to swallow. So that will be where the pressure ultimately comes from, I think.
Yeah, look, IPOs are the most sensitive to the to markets and shifts, and you saw what happened during the first 6 weeks of the year. It's no surprise we are where we are. I think I agree with what's been said. The pipeline is building. Is it going to be a spectacular year? No. There were a few announced in Europe this morning and over the past week. I think we'll see some improvement. Interesting. I heard the 50% number, but I would tell you, of all the companies we talked to about doing IPOs, 90% wind up not doing IPOs. So there are many other options to exit and monetize.
And how does it look in either in your portfolio or especially maybe when you talk to LPs, John? I mean, are they getting antsy to get some exits? Or, I mean, overall, it's been pretty good for private equity in the past few years.
Again, I think the number was 3-to-1, distributions to draws in our business. So I think in general, what we've seen is a shift where many of our LPs were over-allocated to private equity where they become under-allocated to private equity. So I don't think there is not great urgency as it relates to realizations. Everybody in our industry sort of just kind of keep track of things. We are market takers, we're not market setters. And periodically, the right alternative will be an IPO. In general, we as a firm would like to avoid them because it creates a couple of unfortunate, there's certain aspects of it that are unfortunate. One is a level of uncertainty and sort of market market correlation that we like to avoid. So the problem is, if you could take something public and sell all your stock, well, you'd know what you were getting into. What in fact happens is you can sell a small portion, and only a small portion of your stock, and then you're subject to the vagaries of the market. So, I saw my partner over there, Mr. Sokoloff, was involved with a very exciting company called Shake Shack.
Yes.
And Shake Shack was a fantastic public offering. It traded way up, and then it traded way down. And, I don't know if those sorts of gyrations are great for the spirit of the people there. Mm-hmm. They make our marks and the explanations as to how our progress somewhat more challenging, even though the company's performing fabulously. Mm-hmm. Great company with lots of runway ahead of it. So what did going public do for us? Well, it sort of set us up for a series of sales down the road as that company matures.
As an aside, I think it's great that you own both Shake Shack and Lifetime Fitness. I just think that you guys yeah, exactly. Really diversified across
There's
all
a portfolio in there somewhere.
Yes, indeed. So we've talked fairly optimistically. It seems like, and yet we hear signals every now and again from some of the boutiques that there's a little bit of distress out there, a little bit of opportunity for restructuring. How real is that, Steve? I mean, do you hear people talking in distressed ways? Are those guys getting hungry again?
Well, look, no one likes to call their deal distressed.
Of course.
And no one likes to call their company distressed. So, and we had
opportunities to restructure.
Yeah, we had this discussion on the prep call, and I actually did a little bit of a digging after our prep call, and there are a lot of deals happening in the marketplace that are happening because either the business unit being sold is in distress, the company that is selling is looking to maintain the right leverage ratio, the right financial profile. So I think we're already seeing the distressed activity happening. It's happening in oil and gas. It's happening in mining and metals. So it will be a feature throughout the year and beyond.
And Paul, it does seem like there's been this assumption that there will be more and more distress and more restructuring in energy specifically, and yet it really hasn't borne out yet. Is that one of the big opportunities? Where else do you see potential there?
The capital markets are an amazing thing. If you think coming out of the financial crisis, you would have expected to see all kinds of bankruptcies across a variety of industries. And it never really happened to the extent we expected it to. What happened? The capital markets largely bailed these companies out, starting with the high yield market and then the equity markets. And here again, in energy in particular, in the oil patch, you would have expected a lot of bankruptcies. Most of the large cap integrated oil companies kind of like the opportunity for creative destruction. Let's see what happens in the sector, and they'll just pick off the assets that they want. And an amazing thing is happening again. Now all of a sudden, if you look at how these companies are trading, they're actually trading more or less on the expectation that there'll be $75 oil again, right? And actually they're starting to look expensive in terms of how they trade, and the bonds are trading back from where they were. So we may not see the opportunity and distress that we once thought we were going to see as recently as a few months ago.
Robin, what do you see in terms of distress as you look across?
Well, I mean, I think in the commodity-related industries, it's been a very challenging and volatile time. I do think that there's a number of folks in the investing community and otherwise who are figuring out, how am I going to play this trend? How am I going to deal with how am I going to make money out of this? Mm-hmm. The oil and gas industry, for example, is going through an extraordinary shift as these prices and where the supply is going to come from and go to changes. And so as soon as there's some stability in pricing, there will be M&A activity, and there will probably be some restructurings, obviously. So that any commodity-related industry is going through that, and it's not unusual that it would go through that.
But it seems
I don't
like
think
it's a when rather than an if, right? The when just seems...
I agree with that. But I don't think it's broader than those types of industries. I think in general, we're going through an economic cycle which is perhaps in slow motion or not as robust as any of the prior economic cycles have been. But you look at 2015 and everyone said how fabulous 2015 was and everything's great. And then you look at 2016 and woe was me. It's too high. The highs are too high and the lows are, it's better than people are saying, but it wasn't as great as people were saying last year as well. So I do think most of the industries, we're seeing continued growth and good business performance, not fabulous, but good business performance. We're not in an economic situation where there's going to be a lot of bankruptcies. We don't see.
Yeah,
But
I
you know,
mean,
it
when you
depends
say
on, I'm sorry, just the definition of restructuring. So take tech, for example. Facebook, so the last recent earning cycle, Facebook knocks the cover off the ball. I mean, that company is a juggernaut right now, outsized performance, totally surprised everybody. Apple, no growth. Microsoft, not a great quarter. IBM, no top line growth in 15 quarters. So they're not distress or restructuring candidates, but they have serious issues to deal with in terms of driving growth. So that growth is going to have to come, you know, organically to the best of their ability, but most likely through M&A, potentially including Apple as well, who have not had the need to do anything on the M&A front. But how many iPhones can you sell in the world? So the fact that they had a flat quarter is, I think, a very interesting phenomenon. So that may drive a lot of activity going forward, even though they're not distressed or.
Well, and the balance sheets in tech are, especially some of the names you mentioned, are.
Well, 5 companies in tech have $500 billion parked offshore that they won't repatriate to the US because of the tax consequences. But there's $6 trillion in cash just sitting on balance sheets sort of worldwide, ready to be deployed. So the ability for some of these companies, and certainly the big tech companies, you think of Amazon and Google and Apple and Microsoft, their ability to just decide, I want that over there and go out and pay for it is like they could just wipe the floor with anybody else.
Mm-hmm. Yeah.
Do you see that? I mean, do you see tech being sort of, we haven't gone sector specific yet, but I mean, do you see tech being one of the more robust areas for acquisitions, or the big boys being big acquirers?
Look, I think the most active sectors will be, although they may not be in private equity, I think it'll be the lower growth sectors, consumer products, industrial products, the ones that are more tied to GDP, where, you know, managing costs and getting efficiencies through combinations and consolidations can be powerful. I think we'll continue to see a fair bit in life sciences for the reasons we all know. I think tech will be active, but probably not as active as those. Again, there'll be interest in tech from outside of tech. That'll continue to happen.
Yeah.
Anyway, and I agree with Jennifer's comment. I mean, restructuring is a lot broader than what people, you know, think about traditionally in terms of formal insolvency. You'll look at a lot of situations and you won't characterize it as a restructuring, but effectively that's what's happening.
Right. So I want to open it up to questions in just a minute. So put your thinking caps on, ask a smart question. But before I do.
No pressure.
No pressure on anyone.
No bad questions.
There are bad questions. I've made a living doing it. But before we get to that, you know, we haven't really talked about the regulatory environment. And, you know, as most of you know, we are in an election year here in the United States. So you've got that, you've got potential Brexit, you've got a lot of kind of geopolitical, but almost geo-regulatory forces potentially at play. Robin, how do you see this playing out, and how much does that kind of regulatory uncertainty, either domestically or globally, start to play into decision making here?
Good question. Because I think that there has been so much strategic activity, and in part maybe because the administration is towards the back end of obviously their tenure, but I think it's more about the volume and the strategic activity that's happening. We're seeing more antitrust reviews. We're seeing more CFIUS reviews of the China-related businesses. Yep. We're seeing obviously some things on the tax front that seem to be adverse to some of the deal making. That being said, I don't think it's around the edges in terms of what transactions are or aren't going to happen. I don't think it's going to have a significant effect on the overall volume, but any board or management team or investors should always be cognizant of, will this, not only is the price good, but will it close?
Right.
Because it's devastating to these transactions and companies when they go through years of antitrust review and then suddenly there's
dinged.
no. I mean, that's really a tough situation to put back together.
Don Huckle, I mean, you obviously are you mentioned even the effect of the Fed and interest rates and all those different things. That's clearly one way it plays in. What other regulatory things do you worry about from either on the portfolio level or even more broadly as you look to make acquisitions? How much does that play into when you're an investment committee? How much are you talking about that?
It's really transaction specific. There are some businesses where, healthcare obviously, where a change in reimbursement protocols could be devastating or could create tremendous opportunity. So you talk about those things, but in general, I find that the environment changes relatively slowly as it relates to these sorts of things. Maybe the most disruptive for our industry is having to be SEC registered, which has been a nuisance, but actually it's probably been good for the industry. We're probably a little tighter than we used to be. So it's sort of one of those things. Again, our job is basically to take a dollar and to, after taxes, after fees, after carry, return $2 5 years later. So the duration of what we're looking for tends to be 5-6 years. What's kind of going on right now, the election, we don't really worry about that. I would say that history would show that the year after elections tend to be challenging economically. So this year will be fine. Next year, we'll see.
So I think people do deals for strategic reasons. Companies do deals for strategic reasons. Will timing be impacted by tax or other legislation? Yeah. Sure, but I don't see it as a major impact.
So Paul, a U.S. election is more kind of chit chat and less people freaking out over at cocktail parties and less about deal making.
Well, it makes for great Saturday Night Live viewing, for sure.
True. Good for the media business.
But look, it's really hard to make a bet in an M&A transaction based upon what you think the outcome of this election or any election may be. I don't think anybody's doing that. I think if you were to ask me what I'm most concerned about from a regulatory point of view, it's the increasingly high bar we're seeing from an antitrust perspective. So the Halliburton Baker Hughes transaction, for example, was just canceled, and even things like Electrolux buying the GE appliance business, which was also scuttled by antitrust review. I think that's worrisome, and I think it makes it a little bit harder to predict the outcome. And I agree with the comment that that companies do transactions for the right strategic reasons. I think they're a little bit worried as to how to calibrate the effectiveness or the impact of what might need to be divested, right? And there's right now there's a little bit of uncertainty in the market.
Yeah.
And it played out in the extreme way when you saw United Technologies, who always had pursued Honeywell, then have Honeywell turn the tables, and United Technologies say, no, the antitrust regime has changed. We think there's a problem, and eventually Honeywell backed off.
Right. All right, I'm looking out into this brilliant audience for any questions. Raise your hand if you have a question. We will bring a mic to you. I'll keep going if there's not any. Oh, there's one coming around.
Bless you.
You're a good person. It's the first question, so there's no pressure at all to set the tone for Q&A.
I'd like you to drill down a bit more, please, on the activism going overseas. I'd like, where specifically are we expected to see this? What exactly is driving it? And to just talk a little bit more about that trend, assuming that's emerging, as you say.
Steve.
So it's a great question, and so let's be careful in how we describe it. So when I say activism, what I mean is stronger corporate governance, stronger shareholder voice, and more active participation or management around a portfolio. So Will activism as we know it in the US, replicate in the same form in a lot of other countries? Probably not. But if you look at, the Fortune 100 to the FTSE 100, the vast majority of these companies have activists in their shareholder base or shareholders that have acted as activists. You will see, I think, throughout Europe, as there continues to be a bigger push for efficiency and value creation, and we're already seeing it. I think China, again, the reorganization of a lot of the SOEs and optimization of those portfolios. Is it activism as we define it in the US? Probably not, but it's more prudent portfolio management. It's driven by the need for greater efficiency and greater governance. And similarly in Japan, will it take the form of activism? Probably not, but there's only, the path that the companies there have to take is to sharpen their portfolios, create value, and so that's what
So this isn't Ackman goes to China?
No,
But
this is
I
Ackman
actually
goes to
think
China.
that is occurring as well, right? Nelson went into France. We've had a number of people, Elliott, Starboard, and so forth, going over to Asia. So I do think we're going to see some traditional activism all over the world. We've seen it in Switzerland and France. France is tricky. Germany a little bit. UK, because of the broking model, is a little different, so it won't exactly work that way. But in Korea, Japan, Australia, all those countries have had traditional activists sort of mounting campaigns. And I think there's some element that this is testing it out to see how successful it can be. But I do think that around the world, our corporate clients outside of the States have suddenly, or Sony and so forth, there's been a number of things, Samsung that we were dealing with last year, but there's a number of transactions and activist situations around the world, and they're starting to actually develop individual funds or start to raise funds for non-US activists.
And remember, the one thing to remember about activists is that they're constantly in fundraising mode. So they want more and more money coming into their fund to grow their fund so that they can go out and deploy it. So PR is critical. So sometimes it's not so much about actually agitating for change, but it's getting the front page of the Wall Street Journal. So going global.
I'm not familiar with that paper.
Yes, the digital publication book. But it's about getting the press. So activists often target high-profile CEOs, high-profile branded companies, high-profile parts of the world, because the exercise is about driving value for their investors at the end of the day. But getting more and more investors is also, they're constantly in the fundraising game, which is why sometimes they'll take a little piece of a company, get a lot of, razzle-dazzle around it, and money just pours in. And we see that happen time and time again. And remember, when an activist shows up in a stock, they by definition create value because the stocks always go up. Almost without exception, I think a stock will trade up if an activist says, I'm in the stock. So they're looking for people they're competing for investing dollars, and they like the PR.
It's sort of interesting. Again, we've been all watching this so long, but what is an activist? I think is a good question. An activist is, in many cases, a hedge fund who's having a bad quarter. So the point you just made about you're in the stock, you're getting the stock, you make some noise, the stock goes up. What's fascinating to me, and you made the great point that the success of a lot of activists, basically, it's sort of it's because they make very few bets. Some of those work, and then they're geniuses, and some of those don't work, and then they become goats. And the goats you sort of forget about, and you back the geniuses until the next genius comes along. And we mentioned Ackman, but there was a guy that was doing exactly what he was doing right before that, the previous generation was Eddie Lampert.
Yeah.
And he was going to buy things and he was going to make them better, and he bought things and he didn't make them better. And I think you could certainly say the same thing about Ackman as it relates to JCPenney's, for sure, and maybe some of the other things that he's done. I think what I find sort of most challenging is that the narrative, we're going to come and make things better, is rarely, it rarely meets expectations. The expectations set are never met. So we're going to make it better. Well, God forbid they actually get it, because they don't usually do it.
So I have to say I disagree with that.
Okay.
And look, I'm no, we have corporate clients. We don't do a lot of work. We don't do any work actually for activists. But they're not all jump in, cut and run sort of cowboys wearing the black hats. So you think of Value Act at Microsoft. Have been in that stock for a very long time, seats on the board. Look at Microsoft and make your own decision as to whether you think they've added value there. Nelson Peltz at DuPont. Make your own determination as to whether he's a long-term shareholder or a short-term shareholder. Did he add value? I mean, there's all manner of types of activists today, from the sort of guys with the black hats to the people at the other end of the spectrum who can stay in stocks for 5 years, just like the private equity guys typically do, and then everybody in the middle. So there's no more sort of one flavour of things.
Yeah.
But what drives the
That's a fair point.
headlines tends to be the kind of drive-by.
But when we looked at some stats, and stats are always only so good, right, as the data, is that if you looked over a reasonably short to medium term, the stocks of companies that had activists in them or doing campaigns performed better than their relative peer group. But then if you looked out 2 to 3 years, they generally looked worse. Now, maybe that's because the companies were companies that weren't doing well, and maybe that's why they didn't perform, or maybe it's this short-termism. But it's not clear that over a longer period of time, an activist actually makes the stock perform better.
Other questions? You guys are in trouble. Paul, one thing we didn't talk as much about, it's been alluded to a couple times, and we're sort of skirting around it a little bit now, is hostiles. I mean, we seem to have gone through an era where there wasn't a lot of that going on, but there seem to be rumblings. How do you see that sort of playing out over the next year or two?
Yeah, it's a great question, and it does ebb and flow. But and as I mentioned earlier, we saw about a 40% increase last year, and it makes sense in a relatively low growth environment. If if a company has a point of view as to a target, but the target feels that they have over the longer term better prospects than what may be being offered, it creates this natural tension and potentially it ends up with a hostile offer. The problem is that that history has proven that they're very difficult to get done, and so the success rate remains relatively low, and it takes the form of, as I said earlier, just outright hostiles. One company, making an offer for another, or deal jumping, as we saw last year in a number of cases. But again, the success rate not that high. I think it speaks to the available alternatives in a market where financing has been abundant and cheap. And the market had been rising, and so it made for many alternatives for the target companies. And hope springs eternal, right? So if you can make a case that you have other options to create longer-term value, over the history has demonstrated that shareholders have tended to support the hope, as opposed to, in many cases, the cash on the barrelhead at a premium that is not seen as being robust. So it won't go away, but it's certainly going to be it's going to play out through the balance of this year in any number of situations, in our view.
Well, and there's some interesting sort of cross-border implications too. I mean, I'm thinking about the sort of the whole battle for Starwood that we saw in the last couple months. Talking about deal jumping. I mean, that was and also talking about playing out in a very public way, with some well-known brands, with a brand probably that will become better and better known, the Nbang and that whole consortia that's happening from the Chinese perspective. How much does sort of globalization, do you think, play into the broader kind of hostile theme, or does it?
Well, I think it can only add to the equation and the volume, because you've got more parties coming at companies from more parts of the world. As Paul rightly said, they're hard to do, and they're not cheap to do. So, will you see a big increase? I don't know, but globalization certainly will create some increase.
Okay. So we just have a couple minutes left, and I want to give everybody a chance to sort of wrap up to some extent with one big theme that and it could be something that we've already talked about, but something to really leave the audience with as your perception or your prediction for the rest of 2016. If we're all assembled here again in some form next year, what will we be talking about that happened in 2016 as sort of a seminal thing, John?
Well, I'm just sort of inclined to say ditto. It's going to be, there'll be a lot less done in pharma, I believe. A lot of that was sort of get it done before you can't do inversions anymore. A lot of the real estate stuff, not sure. There does seem to be new energy associated with Asian investment in the U.S. It'll be interesting to see how the rhetoric associated with the elections either retards or speeds that up. For us, we're just going to keep doing what we do, which is we'll buy a good company with decent growth prospects and essentially let time and compounding do the work for us. So when we have our investor conference, which will be right about the same time next year, we'll probably tell people that we've done deals just like the ones we did the year before and the year before and the year before and the year before.
Paul, what do you think?
I think it's a global marketplace, as we've demonstrated. We have a relatively low growth environment, but not a lot of perceived risk. So that's usually fertile ground for M&A.
Yeah.
And I'd keep an eye on energy, industrials, and something we haven't talked about, but regional banks in the U.S.
Why regional banks?
Because it's ripe for consolidation. The financial parameters and aspects to consolidation are quite attractive.
And sort of stable after the...
And it's highly fragmented, and
yeah.
it's an obvious place for cost takeouts. And it hasn't happened. It's been long talked about, but it hasn't happened.
Robin, what do you think? Your big theme.
I think it's going to be a steady Eddie, good but not spectacular M&A year. So I think we're going to see more global M&A. I do think that it's going to continue to be strategic. And I just put this one thing out there, which is when you start to see a lot of adjacent deals, non-strategic deals, then start to worry about whether the M&A market has gone too far, and it will slow down after the adjacencies start.
That's good. Steve?
So I think it will be a good year, not a spectacular year, but I think it'll be a very strong year. I think it'll rank in the top quartile of years that we've seen. I think China, and look, that may not be a great prediction because we're already seeing it in the first few months, but outbound activity from China, we've already seen $100 billion. It's a third of the deal volume to date. I think China will be a major player in outbound. I think it'll be a major player on deals, domestic deals, as the SOEs reorganize. And there's still going to be a fair amount of inbound play. So I think that'll be a big theme to the year.
Jennifer, you get the last word.
So I guess my theme would be, and given my vantage point, would be disruption. I think technology right now is changing every industry vertical in incredibly profound ways. What you want to consume, the content you want to consume, on what device, in what fashion, with what advertising, at what speed, is certainly just changing everybody's lives, I think. And that is going to drive a lot of very good deal making as people try to position themselves for the right assets. And it's going to drive potentially a lot of bad deal making as people make the wrong bets. But I would guess a pickup in M&A activity in the near term because there's just too much concern over grabbing the right assets before the market and technology cycles sort of move away from you.
Excellent. We're going to finish on time, under budget. Jennifer, Robin, Paul, Steve, John, thank you very much, and thank you for joining us.